we welcome you into another week of Scrushy on Business. My name is Dave Green. Richard Scrushy, as always, is alongside, and we appreciate folks that are coming in and watching us, listening to us, and of course, those who have been writing in at info@scrushyonbusiness.com. And we are going to get to a lot of folks who wrote in this week, Richard, and good to see you. And how are things with you this week?
Things are good with me. How about yourself?
Things are good. Things have been very
Yeah.
busy. I'm, of course, in the throes of some things that we're going to talk about today. So I'll be interested to hear some of your answers as it may relate to some of the things that we're actually living right now.
Well, yep. I'm really excited about these shows where you and I get to talk because when we have the guest, we're obligated, obviously, to ask them questions and let them tell all about their businesses. And I know that people out there enjoy that and like to hear about those things. But there are a lot of other things that, you and I want to share and want to talk about. And last week we started talking about five things that are pretty important. Number one, validation of whatever your idea is, and then. But I do want to say go back to what you just said. Yeah, we have these questions. These people, I mean, we're talking about some really smart listeners out there because these questions are tough questions, but they're good questions, and they're questions that I know need to be answered when you're building a business or starting a business. So I want to get through this, and then we want to get to that because I know that those things are important. But we talked about five different things. We talked about your idea to validation. We talked about how do you structure your company when you're starting it up. And that of course is driven by what is your long term aspirations or your what do you plan on doing with the company. And we talked about what is the product that can you really explain it? If you can't explain to me what your product is, you're probably going to have a hard time selling it. Uh, and then we talked about your first customers, determining, do you have five customers? Do you have two? Do you have 10? One of the things that creates value when you are selling a company or you're trying to raise money and you're pitching to investors or you take out to the public market, they want to know who are your customers. And if those customers are international, if they're in every city across America, boy, that's going to carry a lot of weight. If it's a limited niche and let's just say you can only service one niche, maybe that niche might be, I don't know, tractor companies, or it might be, dentist, or it might be, depending on what you're doing, it could just be one niche. But if you have some kind of global product or, and it's okay if you just serve doctors. I mean, because there's plenty of doctors. I think Houston, Texas has got like 50,000 doctors. So, I
Hmm.
mean, that's a huge market, but you need to be able to identify who your customers are and are they local, are they regional, are they global, or what are they? So it's those kind of things. And then we need to talk just a little bit about funding your company and probably Dave, I think most companies in America, people bootstrap. I mean, they just they try to, you hate to go out and say, well, I need $10 million to start this company. That's kind of a big, number, but it really may need 10 million. I
Right.
mean, they try to do it with 100,000 or 200,000 or even a million, and you need 10 million, and then they fail, and then they're never able to get traction. They're never able to build it. I have seen that so many times, underfunding. So then here comes the next thing, and the fifth thing is, how do you sell it? How do you pitch it? If you've got to raise 10 million, or you've got to raise 5 million, or two, or whatever, or 50, how are you going to pitch it? How are you going to sell it? What are you going to say? What does your presentation look like? How polished is it? Have you answered all the questions? Have you really drilled down on the numbers? Because when you go to a professional investor, they're going to ask you all the right questions, and they'll take you apart if you don't have the answers. And if they can find a hole somewhere, they will just dig right into it and just tear you apart in that hole. And a lot of that comes, these five things I've talked about. Why did you structure it this way? Validate your product. What is your product? Who's going to buy it? And how big is the audience that can purchase it? And then what is the price? What is the going price? Are there other companies that do it? So there's always are you first out of the box, or is this a Me Too company? If it's a Me Too company, what are you doing different? Okay, so what is your product? What are you doing different? Let's talk about that. And then, who are your customers, and what is their need, and how many of them do you have to have in order to be able to make this work? And then when we start talking about raising the money, you really need to have a good cash flow analysis. What is it going to take? How much does it cost to build one of these? If it's going to be individual facility or a store or a retail outlet, yeah, what does it cost to get one of them up and running? Back in the day when I built Health South, I'll tell you what I did. I had this idea of this comprehensive outpatient rehabilitation facility. So I built I built the first one. Now it was really interesting. I have to tell this story. You're going to love this, Dave. So I had the venture capitalist with Citicorp Venture Capital, a great guy, Matt Mikowski. He's a wonderful guy. Came in and he said, Richard, don't build the first one in your backyard. And I said, why is that, Matt? And he said, because everybody that comes to see you is going to see it. And I said, so? He says, yeah, but let me tell you, he said, the first one is never right. He said, you build your second one in your backyard. He said, build the first one somewhere else. Well, we were based in Birmingham, Alabama. So I built the first one in Little Rock, Arkansas. And people made fun of me. They said, well, you put it in a place where, that's not a destination. I mean, people don't say, well, hey, I think I want to go to Little Rock today. And look, Little Rock's a beautiful city, and I'm not knocking Little Rock. I like Little Rock, built on the river, and it's a great city. And it, you got North and South Little Rock, and if you live on one side of it, you don't go to the other. The politics are crazy over there; they really are. So we built the first one in Little Rock, and then that was an issue because we built it on one side of the river, and the folks on the other side of the river said we don't go over there. And so, but the politics of the city and people that live in Little Rock understand fully what I said, what I'm talking about there. But then our teeth on that one. And did we make mistakes? Yes. Did we build it exactly like it should have been built? No. Did we structure it like it should have been structured? I think we did the structure right, but we didn't do the everything else right. And so we had to cut our teeth and we learned. And it took it a while for that one to get traction and start making money. So the second one we built in our hometown, and it was far better. And it got to profitability much quicker. It was a much nicer facility. It was able to see more patients, and we did all the right things. And then the third one, we actually went to all the way down to Miami, and we bought a facility that was an existing small rehab facility that was primarily doing treating orthopedic patients. And we bought that. It was Miami Rehab Institute, MRI. And then from that, we then turned that into a comprehensive outpatient rehabilitation facility. So we made an acquisition. So today we're going to talk a little bit about acquiring versus startup and building your own. So I wanted to throw that in there. And a lot of times, you can take something that is out there, like we bought, that wasn't exactly our model, but we bought it and we molded it and brought all of our services and built it into what we wanted. And then from there, I think we went to Jackson, Mississippi, and Baltimore. Now, this is real interesting because the investor said to us, if you're going to take this public, you need to prove to those investors that this can be a national company, that you're not going to be limited just to a regional area. So that's why we went to Miami. That's why we went to Baltimore. That's why we went to, we started expanding. We weren't just going to be in Birmingham and Jackson, Mississippi, and Atlanta, Georgia, and that surrounding area. So we went ahead and we started expanding outside of our regional area. And by doing that, we were able to prove to Wall Street when we did have 20, 30 facilities and we had become profitable, we were able to say, look, this is a national company. We can go anywhere. We can treat people from, one end of this country to the other. That carried a lot of weight with us being able to raise money. And of course, it helped us raise our second and our third round of venture capital before we ever went public. So these are things you have to think about, but you want to make sure that you fund it. Now, we knew that we didn't have enough money in the original funding. We already knew that. But what we did was we said, okay, we're going to raise this much money on this funding, and we're going to achieve, this milestone. So I think we had like 6 facilities up and running. And then we went and did our next, that was I think it was 5 or 6. And then we did our second round of funding. But we didn't know if we were going to if that was going to be enough or not. We didn't think it would be. And then as we built out more, we did require one more round of venture capital. And then that got us to profitability and we were able to take the company public. But it was okay that we did 3 rounds because we had milestones. We grew the company so that when we sold off equity in the company, sure, the management had to take some dilution. We reduced the ownership we had, but we went from being a small, 3 or 4 facilities to, 30 facilities. And so owning a smaller piece in terms of a percentage, we actually owned more because it was a bigger company. And so even though, our percent went down, our ownership and of what we really bought or what we owned went up. So there are things that you gotta kind of work through and make plans. So if I was out, let's just say, and I was going to build a chain of restaurants, and I wanted to prove that my concept worked, I probably would build 1 or 2, and I would sit there and I'd make sure those things were working really good and that the concept would catch on and get traction. And then once I saw that they were making it, I may have to raise another round of capital to go out and build 5 more or 6 more or 7 more. You see what I'm saying?
Hmm.
So, be smart about it. You don't need to go out and raise $100 million because you think, you just get it up and running. But I had to raise enough to get the initial facilities up and going. Now, and I did have my own money in, and back in that day, the venture capitalists required skin in the game, and it, by us having my own money in, meant a lot. It said,
Made a
okay, he's got
difference.
skin in the game. He's in your situation, Dave, that you're working on. Have you guys got skin in the game?
We do, and it does make a huge difference because I've done it the other way, where you're I felt like as you were asking for sweat equity that, clearly the other side had all the leverage, right? As long as they were giving you something, I think they felt like they could keep bringing it down if they needed to. But when you've got the skin in the game, we're currently in really in 2 situations. One where we've invested money in order to, in a sense, test something that we want to grow much larger,
Hmm.
and have spent that money so that we're now going to investors and saying, okay, this opportunity we know has legs, and here's what we have done to get
There you
here, and
go. Yeah.
we're willing to put in. You know, I wanted to ask you, when you went from 6 to 30,
Hmm.
what percent of those were you buying companies that were existing versus now opening brand new locations?
That's a great question. Probably about a third of them were acquisitions. What we were doing was kind of a new concept, but none of the acquisitions that we made, Dave, were comprehensive outpatient rehab facilities. They would have some portion of it. So what we would do, we would go into a city and say, okay, here's a really good, you know, uh, occupational therapy rehab facility. We would, or flow of patients, relationships with doctors, relationships in the community, and that entity had a brand that was not that was known. So we would buy that, and then we would bring in all of the other things that we wanted to do, which might be speech therapy, it might be sports medicine, it might be treating stroke patients, head injury, whatever we might bring in. So we would then expand that facility to do more. Now, in the process of that, we would then change the name and we would then brand it with our name, but we already had a flow of business. So that facility would be profitable. So we didn't have any, we weren't burning any capital. I mean, we've got billing going on, we got patient flow going on. And so we're just expanding it. And sometimes we had to move it. Sometimes we had to rent additional space, but we would then, and not always. I mean, a lot of times it would be plenty big and we could just add a few services and it would just meet our minimum standard. But there was Medicare had authorized, it was called a CORF, Comprehensive Outpatient Rehab Facility. And you could get a provider number. You could provide all the services that they allowed under that name, under that
Hmm.
title, and you could bill Medicare. And then we had a real hard time though getting Blue Cross and Aetna and all the other insurance companies to pay. They didn't know what we were. That was a real challenge at first, and they'd say, "Well, what are you?" I mean, I was talking to the guy at Cigna. He said, "Well, what exactly are you?" And I said, "Well, we do physical rehabilitation, and we do occupational medicine, and we do this and we do that." Oh, okay. And I said, "So, this is something that you guys are paying for, but right now it's a piece of it over here and a piece of it over there. Well, we just put it all into one facility." And by doing that, I had to explain to them, by putting it all into one facility, we had one rent, we had one business office, we had one reception area, we had, one set of, electrical bills and everything else. So we were able to reduce the cost. So you didn't have to go to five different places to get those services. You could go into one. And so we were able to be very cost effective in terms of our pricing and our billing to the insurance carriers and to Medicare. Made a lot of sense, and it worked very, very well. And our whole goal was to reduce. What was the concept? It was reduce healthcare costs but increase the quality. At the same time that we were making it cost effective, we were providing them a very high quality care, and we were moving the patients through the system to get them off the healthcare dollar, helping bring them out of the hospitals earlier so they could get the rehab and get the treatment, and go home and get them back to work and get them back, kids back in school and athletes back playing again. So, but yeah, about a third, to answer your question, we would find things that we could, but then there were markets we just wanted to be in, and we knew we had to be in, but we had to go build those referral networks. That was the first thing we had to do. We had to make sure if we build it, are we going to have referrals? And so we would then identify ourselves with doctors in the community that said, yeah, we'll use your facility. So, did you have another question on that, Dave?
Well, I just wanted to point out too, as you talked about those five things, that most of it comes down to you, right? The person making that presentation. You're always going to have people who are going to have questions, and as you said, the more polished of an investor you have, the more polished the questions are going to be, and you have to be prepared for it. But typically, either what's going to get you that meeting or get you that deal across the finish line is you, is your passion for what it is that you're doing and your knowledge for what it is that you're doing. If you listen to Richard speak about the medical industry, it's, you have an incredible amount of knowledge about what you were doing, right? As opposed to just somebody who was running a business at the top of it and not being in the trenches. You had been in those trenches and continued to be. So you have to have that knowledge. But what most people were investing in was Richard Scrushy. Would you
Well,
agree?
yeah, I do believe that that played a role, and especially I saw it when I went to Wall Street, because I was able to communicate what our goals were, what our plans were, what we were going to build, how we were going to build it, why it made sense, why the insurance companies would work with us, why it made sense for the government and Medicare. So, I was able to pitch all of that and to make that make sense. We touched on a little bit about acquisitions, and you asked me about how many we buy. I mean, we looked at a lot. We didn't always buy them, Dave. There were some that we looked at and we said, "No, nah, we don't want that." They had problems, they had issues, and we would go in and take a look at their books, and we'd take a look at the cleanliness of the facility and the chemistry of the people, and then we would go, do a little due diligence within the community to find out what kind of people thought about them, and sometimes it was not good.
Yeah, that I was going to ask you, that is, how do you do that? Is that through hospital connections? What were you doing specifically in a market? Because obviously you have the books and you can see where they are financially, but you also knew you would be changing it dramatically. So that other stuff becomes incredibly important. How would you go into a market you weren't as familiar with and say, we got to figure out what the reputation is here?
You know, yeah, I love that question because I did it all the time. And believe it or not, I would go into a restaurant, have breakfast, and I would say to the waitress, "Hey, are you familiar with that facility down the street down there? And here's what they do, and what do you know about them?" And sometimes I would get, "Oh, you don't want to go there." you know, I'd say,
Run.
"Why?" Oh, they have horrible reputation. Or they would say, "Hey, my aunt went there and she loved it, and they did a great job, as a matter of fact, and got her back, to work again. And they fixed her hip, and they fixed her knee, or they did this." And I said, "Really? Well, have you ever been in there? I mean, is the place nice? Is it clean?" And you would hear positive things, and then, but if you went and someone said, "Oh, you do not want to go there. You don't want to deal with them," you would find out things like that. And just first of all, that's kind of it, just being in the community, kind of what is the image, what are they thinking about it, and then of course location, location, location. Management, management, management. I mean, you got to go in and interview the management. You got to look at the location, and sometimes uh, it's just a bad location. And you just thought, well, this, we don't want to be in this area right here. This is not a good area. This is not where we want to be. But all of those things played a role. But you would go in and meet the management, and then you would walk through the facility. You could tell, you know, Dave, when you walk through a facility, whether people are mad or nice or
Mm.
happy. Or you see it in a restaurant. We talked about that last week. There was a restaurant that I used to frequent, and everybody was happy, and it was great, and service was great, and the manager would come over the table, and he would shake your hand, and how you doing today? Is there anything I can do for you? And then all of a sudden now he's gone, and they got a new manager, and we never see her, and
Right.
everybody's mad, and people are quitting, and the whole service went to heck in a handbasket, and they wouldn't give you an extra glass of tea, and so things begin to deteriorate. But you walk through a facility, it won't take you long. One of the things we used to look at too was how clean is it? I mean, if if I'm going to buy it and I'm going to pay for it, I'd like to think that I'm buying it from somebody. If those people are going to stay employed, I'd like to know that they run a really jam up facility. You look for state of the art equipment. And then, of course, when they give you their financial statements and all of that, you want to make sure that that's properly organized. And then when your financial people come in and they begin to do their due diligence and they come back and they say, this says this, but that ain't what we found. Then you start to have problems. They have $250,000 worth of equipment on the list, but we looked at it and it's really only about 150. So all that's not there. So there's things that are missing. So with those things you would find, and in most of those cases you probably walk away from that acquisition. But uh, and what let's say you find a decent acquisition, and a lot of times they were excellent, and we wanted to buy them. But I will say this. I got to say it. Sometimes you go in and you look at it and you say, well, they're not making very much money. They're in a good location. They're not making very much money. Why? And you look around and you study it and you figure out, I know why they're not making much money. I've got it. And you see, there's three or four things that should have been done. And if they did those things, it would be making a lot more money. Now, in those situations where I like the business and I like the location, many times I would be able to buy those operations cheap. I went into a hospital one time, and I have to tell you this, it was for sale. And I met with the manager, the guy that owned it. And I walked through the hospital, and it was dirty. Even the nurses didn't even have on clean
Mm.
outfits. And I was like, boy, this place is filthy. And it was orange and yellow, Dave, the interior. And I said, well, who would want to be in this place? This place is horrible. But as I walked through it, I said, this is in a great location. The building structure was great. They had looked like decent equipment and decent, furniture and everything there. But when I walked through it, I said, you know what? If I bought this, I would paint it. I would change it. I would get new uniforms on all my people. I would do it. And I could see everything that I wanted to do. I want you to know that I bought that hospital for $7 million.
Mm.
Okay. And I knew that I could turn that hospital around and it would be worth 2 to 3 to 4 times that. And that's exactly what I did. And I want you to know that that hospital is in Houston, Texas. And that was one of the first few hospitals we bought. And I drive by that hospital 5 times a week right now today because I live in the Houston area. And so I drive by it. I see it all the time. And that hospital is still there. And now think about it. I bought that hospital in the 80s
Yeah.
for $7 million. I did a renovation. And I don't know if you remember when Warren Moon was playing with the Oilers
Sure.
back in the day, he was quarterback. Warren Moon, when I bought it and I renovated it and I did another grand opening and a ribbon cutting, Warren Moon came to that opening and gave a little talk and a little speech. And we had a big ceremony, and it was a great event. And that hospital today is still running. Can you imagine after all of those years
Hmm.
what the return has been on that
What do
$7 million?
you think it's worth today?
Oh my gosh. That hospital, probably 30 million,
Yeah.
35 million. Okay. If I mean, maybe even more because the location is fantastic. It's in a great location. It's running today. I'm sure it's full. But those kinds of things, back in the day, I'd look for deals. So a lot of times you buy things that you can buy cheap, if you will, or undervalued because it wasn't run right.
Right.
But it doesn't mean that it's a bad acquisition.
Yeah.
And let me tell you, and if I can fix it and I can clean it up and I can make it better, and I'll buy it. I did a deal one time, and I'll just tell you this. This is kind of fun, and I don't want to use up all our time, but I went in and I was buying several hospitals, and they had hospitals that were making money, and they had hospitals that were losing money. So when I'm looking at that, they had combined them in a financial statement and said, "Here's what these hospitals are making." And we want a multiple on that profit right there. So they took these hospitals that were losing money and they took the hospitals that were making money and they put it all together into one financial statement. Now, that means that the bottom line, these losses over here were added to these profits over here. And so that cut the overall profit way down. And so they put a multiple on that profit. And so I'm sitting in there talking with the guy that's selling the hospitals, the CEO of the company. And I'm looking at that and I said, he ain't very bright, is he? Because if he was smart, he'd give me those that are losing and put the multiple on the ones that are making money. Do you follow what I'm saying? Because
Yes.
when he just give them to me. No, because when he put them together, it reduced the overall profit. So it really cut what he was trying to get in half, what he could have gotten. He could have said, here, just take these and do whatever you want to with them. And we're going to put the multiple on these over here. And the multiple then the price would have been twice as much. I don't know if you understand the math, what I'm
Sure.
saying,
Yeah.
but uh, so you see things like that when you're out there and you're building a business and you're growing, you see opportunities. And so, that was an interesting time for me when I was really building and growing, and Wall Street was providing the money because we were able to go out and raise equity on Wall Street. We were able to do a couple of rounds of equity, and of course, doing rounds of equity on Wall Street is much cheaper money than trying to do it on a venture capital level where they're going to take a big cut of, big piece of flesh. You get out there on the public markets where they're paying 18, 20, and 30 times your earnings versus some guy trying to pay 3 or 4 or 5 times your earnings is totally a different world. So, anyways, and so sometimes you buy things because it is a good buy, just because it's underpriced. But one thing you got to be careful with when you're buying something, you got to decide: do I buy the corporation, do I buy the partnership, or do I just buy the assets? And that really depends on their past. Now, if they've got kind of a tainted past and they've got some problems and they've got some lawsuits or they've had some issues or they've had some trouble with, getting paid with Medicare and different things, you may not want to buy that corporation. You may not want to bring that baggage forward to you. You may just want to buy the assets. Sometimes you have to buy the corporation or the partnership because it might own the license to operate. But if you can transfer that license into a new company and you don't have to bring the baggage, but if something's been operating there and they've been treating patients for several years, and you buy it and you buy the corporation, and you bring all the shares into your company, you still could get a lawsuit from somebody that something happened a year ago or 2 years ago, uh, and then that would come after your company because you now own those shares and you own that company. That actually happened to us. I'll tell you just a real quick story. I was buying a company that had a bunch of hospitals. I think they had like 28 hospitals, and so we were buying that company, and they had a bunch of nursing homes as well. And at the time, I was not in the nursing home business, and I didn't want to own the nursing homes, and I had a buyer for the nursing homes. So what I did, I bought the company and because I wanted the 28 hospitals. Okay, but I had a buyer, so I only owned the nursing homes for 1 week.
Hmm.
My buyer came in and bought the nursing homes. I held them for 1 week because I had him all set up to buy. So for 1 week, well, you're not gonna believe this. When I bought that corporation and then I sold him the nursing homes, I didn't sell him the corporations. I just sold him all those assets out of it. Well, apparently a patient had died in one of those nursing homes a year or two before. And and so here comes a plaintiff attorney suing us for the wrongful death of this patient that had died, wasn't even on our watch, had died when the other people owned it. Okay. But we didn't know about it. Of course, when you buy a company, and I'm getting into some complex stuff, you want to make sure you buy the tail on the insurance. So we bought the tail and we had like 50 million in insurance. Okay. But they got a judgment against us for $21 million for the
Hmm.
death of that patient. We didn't even own the facility when the patient died. But, and it came right out of that 50 million, that tail that we had. So one of the things that I did, because I didn't want to have to go through any more of that, I structured a deal where I sold that corporation with a couple of hospitals that we had to another entity. And I got rid of that corporation because I didn't want any additional lawsuits coming. Now, I bring that up because, when you start looking at making an acquisition of whatever it is, you got to make sure that you've got the insurance is there, and anything that might come up in the past, any wrongdoing that they did, that you're not going to be, carrying that forward. Uh, I got this. Somebody sent me this thing from National Law Review on my former company, and they're going through some stuff right now. Matter of fact, have you got? Can I mention this, and then we'll get on these questions? This won't
Yeah,
take.
because we talked about it a few weeks ago. So
Yeah.
follow up on what's happened.
Yeah, a matter of fact, here's what it says. It says the investigation concerns whether Encompass Health or certain officers have violated the federal security laws and are engaged in other unlawful business practices. So, they're going through some problems. And then there's this long list of all of these injuries and people that actually died in the facilities because of things that went wrong and were not properly done. So, you know, those things are going to linger on, and I'm sure there's going to be a lot of legal things that go along with that, whatever. And I don't have any answer. I don't know whether they did anything wrong or not. But the bottom line is these lawyers are going to dig and dig and dig, and I'm sure they're going to continue to try and get settlements for the families and on and on and on. And I don't know what else is going to happen, but if you're buying a company that's had problems like this, you may want to make sure that you're covered. Because if you buy the actual stock, you're going to be bringing all of this onto your balance sheet, all of this into your company. Now, this is a big company, but I'm talking about even a small company. If you're buying a restaurant, and there was a slip and fall in there
Right.
2 months before you bought it and you didn't know about it, and you get sued and you bought the stock, you own the company, the corporation, or the partnership. I mean, you're liable. You're going to be the one that's having to deal with it. So there are a lot of things that you have to think about, especially when you're selling. If it's a product that you've been selling and something that somebody could have an issue with or get hurt or something down the road. I mean, there's 100 different things we could talk about, but these are things you have to be careful about when you're building, buying, acquiring, whatever. So, and I don't want to spend this whole show. I know we can talk more and more about this as we go forward, but these are concerns. These are things that people have to be concerned about when they're making an acquisition. Why don't you throw a couple more questions out there because I know we're running out of time.
Yeah, you mentioned the opportunity sometime to find businesses that are good deals.
Mhm.
Stephanie from Dallas had written in and asked, "What's the difference between buying a distressed company at a discount versus buying a profitable one at full value? Which can be the better play?"
Yeah, yeah. I you can overpay for a company. I mean, you can overpay for a business, and if it's doing like really, really, really well, and you pay full value for it, and the owner pulls out and somebody leaves, and we had to deal with this all the time, especially in rehab facilities that were freestanding. A lot of times it was a physical therapist that was bringing all the business because they had grown up in that community and they had personal relationships with those doctors that referring those patients. And if that physical therapist pulled out of that rehab facility or that occupational therapist, we lost the business. And if we paid full dollar for it, we would, it would hurt us. So we had to put deals together to make sure that that physical therapist wasn't going anywhere. If we
Right.
determined that was the breadwinner, that's why this thing is working so well. So we'd structure a deal to make sure that that physical therapist was not going to leave us, at least for a few years, and put some kind of non-compete in place so that if they did leave, they couldn't go out and take our business away from us the next day, because that would happen, and it did happen. So a lot of times, if you're going to pay full value for it, it's okay, but you got to make sure that everything is in place to keep that revenue stream going and that profitability going, so that you really do get the benefit of what you bought. And then as far as buying distressed, just make doggone sure that you're going to be able to turn that thing around, because I mean, there's some dogs out there that you're not going to be able to turn around. And we bought a chain of hospitals once, and there were several in it, and one of the hospitals did not meet code. And we went to do some renovation, and it didn't meet code, and we're going to have to spend a fortune to get that hospital fixed and up and running. And it was just not in the right place. We could never get it turned around. Finally, I just said, look, sell the hospital, get rid of it. So we got rid of it. There were buyers out there, and we didn't get a good price for it either. I can tell you that right now. But it was better to sell it than to continue to lose money. So, we had to make a financial decision about, do we continue losing money, or we just take what we can get for it? Because there's nothing we could do except spend more money on a bad location, on something that didn't meet code, renovate it, and then it's still in a bad location, even if we renovated it and fixed it. And so we let somebody else go have that. And so, yeah, that's a good question. And it really depends on whether or not you think you really can turn that thing around. If it's, you're buying something that's not doing so well. So,
Sean from Philadelphia wrote in, if you don't have millions in the bank, what are realistic ways to finance an acquisition? So you want to be in business, but you don't necessarily have all the money that it takes.
yeah, that's really the biggest problem everybody has, isn't it? We don't have enough money. We never have enough money. Never have. But yeah, that's a tough one. You just you have to look at what the value is of what you're trying to do. What is it going to cost? Uh, are people funding that right now? Can you get yourself in front of someone that might have an interest in funding it? And it just depends. I mean, I'm telling you, it depends on where you live. I mean, they're investors that will invest in Houston that might not invest in Birmingham, Alabama. I'm just telling you, or Little Rock, Arkansas. They're investors in Dallas. They're investors in New York. And it depends on what you've got and what you're presenting and what your numbers are and what your return is. And it depends on, like you said earlier, Dave, it depends on you. What is your background? What have you done in your life? What are you going to be bringing to the table? And how are you going to present it? And how does everything stack up? And, what are the milestones? And is it a viable product? Is it a viable company? Is it a good is this something that you can sell and it can become a nationwide company or an international company? There's a lot of questions like that. There's steps you can go through that can prove out all of those things. And I would just say that you got to start at the bottom and you got to walk through those steps.
Along those same lines, assuming you do have the money, Tony from the Boston area writes in and asks, Richard, when should you bring in outside investors or partners versus trying to buy the company yourself?
No, well, if you have the money, you can go ahead and do whatever you want. Right? But no, look, there's nothing wrong with having partners. There's nothing wrong with having investors. Investors, especially if they're wise, and you having people that you can put on your board that can advise you, that can help you, that can be there when you need to expand. Um, a lot of businesses, hit the wall, can only go so far because they just don't have the money to expand, even though they have good concepts and maybe they have some level of profitability. But if they just had more money, they could expand, they could grow, they could open more locations and go into other areas. So you will know. you will know when you get there. You know, it's like we were talking to Cody. You know, he reached a point where they had grown that business they had to where they didn't even want to. He didn't want to own it any longer. It was no, it was not fun. So you reach that point. But when you're building it, it is fun. I'll just tell you right now, building a business, building a company is fun. Uh, and if you're doing it all right and you got the right people and you got a good concept and the returns are there, the chances are there are investors out there somewhere that will invest in your niche. And there's some niches they're not interested in, but you know, chances are if everything is there and the returns are there and the growth is there and the leadership, you've got the people, chances are you're going to be able to raise the money. It just, you know, you can get in front of, start with your angel folks. You start, might even be your own money, your relatives, whoever it might be. It might be friends, it might be local wealthy people. And then eventually get yourself in front of an institution that can really fund it. If you were going to take it nationwide, you're going to have some serious money. And it might be that you build it up to a point to where it's profitable enough that you could take it to the NASDAQ. And that would be the ultimate thing. Go to the NASDAQ, raise 20, raise 30, raise $50 million to where you can build it into a nationwide company.
We'll end on this one. Rachel in Denver asks, what's the hardest part after the deal closes? Keeping employees, merging cultures, or growing revenue?
My gosh, it's all of the above. All of the, I'd say every one of them. You know, it's funny. You buy when you buy a company, there are always going to be naysayers. There are always going to be people that are not going to want to stay with you. And then if you can meet with the people and you can talk to them and you can say, look, we're we're buying this company, we're paying hard-earned money, we want to build it, we want to grow it, we want to give you a future. You know, we're going to be bigger, we're going to have more opportunities, you're going to have more opportunities. If you can pitch and sell and get your people that you're acquiring to continue to grow with you and stay with you, the ones that are really good. I mean, that's the best way to be. Now, and sometimes you buy a company, you know, you've got in your company, you've got all your financial people, you've got your IT people, you've got your lawyers, you got your development, you got your sales team, you got human resources, and then they've got all of that too. So now you've just bought this other business, and now you got twice as many people as you need at the headquarters.
Right.
So that means you don't need all those folks. Now that's a really hard thing to go in there when you start slashing. And you might need some of them because you say, well, I'm going to be double the size, so I'm going to need some of them to help grow, whatnot. But they all got to leave there. That was in Albuquerque. We're now over here in Houston. So you got to leave Albuquerque and you got to move to Houston because this is where we want you to work. Well, that's a problem because those people don't want to leave home. Then that's where the kids go to school and then that's where the grandparents are. So they're not coming. So now you're beginning to rip this thing apart. Now you bought this company, you got all this money invested in it, and now you're kind of tearing apart the structure. And those people that were with it for the last 15 years are no longer going to be there because they're not going to come here. Some of them, the younger ones, will, and they'll stick with you. So now, when all of that shakeup begins to take place, you're trying to hold this thing together and do what was one of the things you said: keep the revenue going and grow the company. You see what happens. So when you do something like that, it's a challenge, and you got to have infrastructure in place to be able to absorb that. You know, one of the things that we did when I was building a national company, I had in what I called a pristine audit. And that audit was all about making sure that all those assets were there. They would verify the assets. They would make sure that we met all the minimum standards. And you wouldn't have things like this happening to you that I talked about this morning because you had standards in place and everybody had to meet those standards. And you were constantly auditing, making sure that everything was happening. So when we would buy a facility, it would automatically roll under that audit, roll under that pristine process. And we would say, okay, here are 50 things that you've got to do immediately, and we're going to inspect you in 45 days, and you got to do all of those things. That would immediately take that operation and pull it right into a standard of performance that it had to meet, which then put that operation up at the same level that we were at in terms of quality and performance and patient care. Those things are important. Structuring, a, when you're acquiring multi companies and trying to put all that together, and you got people that are leaving and they're talking ugly about you, right? And at the same time, you're over there trying to motivate them and keep the people that you want. It's a challenge. It's a lot of work, but it can be done. And companies do it all the time, but it takes great leadership. It takes commitment. It takes somebody getting up early every morning, thinking through it, planning, putting the right people in place, and doing all the right things.
Lot that you have to do, and it's great insight from Richard Scrushy once again. If you're watching us on YouTube, we hope you will click like on this video. Make sure you're subscribing to the page. If you hit that bell, you'll get the reminders when new content is up. And of course, if you have questions for Richard, you can email in info@scrushyonbusiness.com. And it was good conversation today. We'll be back again next week talking business. And Richard, before we head out, I'll give you the last word.
I'm looking at all the questions that we got in, Dave. You got 20 questions that we've not even gotten to yet. So, before we bring on another CEO, I think we probably need to go through some more of these questions and answer them. We got a lot of things to talk about in the future. A lot of good things coming down the pike, folks. Follow that dream. You too can build a multi-billion-dollar company. Just need to follow the dream and do the things that we're talking about. Look, info is scrushyonbusiness.com. Send in your questions.
Keep it locked in. We hope you'll be with us each and every week right here on Scrushy on Business. We'll see you next week, everyone.